Miss your county's senior exemption filing the year you turned 65, and you could pay $1,000 more in property tax than your neighbor for the exact same house. Not because your home is worth more, because they filed, and you did not know to. Many homeowners assume the county will personally notify them when they become eligible. In most places, it will not. You have to apply yourself. There is a deadline on the calendar. Miss it, and in many counties, you lose that year's savings, unless a late or retroactive application is available where you live. That is not a one-time cost. Miss the school tax freeze, and you are overpaying every year home values rise, year after year, until you file. I am your guide to real-world retirement decisions, the retirement numbers your advisor never ran, and the county office will never call to remind you about. Here is what most people do not know. There is not one property tax break for seniors. There are 4 different programs. An exemption lowers your taxable assessed value. In states like Texas, a school tax freeze locks the school tax portion of your bill at whatever it was the year you first qualified, no matter how much values rise after that. A circuit breaker credit limits what you owe as a share of your income, and a deferral program lets you postpone the tax entirely. The freeze is the one many homeowners never think to ask about, and in a rising market, it can be worth more than the exemption itself. In the next 15 minutes, you will see which programs exist, how to check your county, and the one question to ask your assessor before you leave. A quick ask before Part 1. If breakdowns like this save you money, hit like and subscribe now so the next one shows up for you automatically. One note before we start. The amounts and income limits I will mention are state and county specific, and they change year to year. By the time we finish, you will know which questions to ask, which is more useful than the right answer for someone else's county. Part 1. What these breaks actually are, and what they are not. A lot of people hear that seniors can get a property tax break, and they picture one thing: a complete exemption. No more property tax at 65. That is not how it works, and the versions of this you see online that promise seniors simply stop paying are misleading. What is actually true is that there are 4 common categories of relief that many states make available to homeowners over 65, and many eligible homeowners never claim a single one. The first is the Senior Homestead Exemption, an extra chunk of your home's assessed value shielded from taxation specifically because you are 65 or older. Every state does this differently. Some offer a flat dollar amount, some stack it on top of a regular homestead exemption you already have. Either way, you're taxed on a smaller slice of what your home is worth on paper. The second tool is an assessment freeze, or a tax ceiling, the one most people have never heard of, and arguably the most valuable over time. Normally, as your home's assessed value climbs each year, your tax bill climbs with it. A freeze stops that once you qualify at 65, subject to the program's own rules. If you have owned your home 15 or 20 years in an area where values have climbed substantially, this tool may be worth more than the exemption itself. The third is a circuit breaker credit, income-based. The idea is that for lower-income seniors, the property tax bill as a share of income can become genuinely crushing. Once your property tax climbs past a set share of your household income, the program returns part of it to you, usually as a credit or refund. Not every state offers this, but if you are on a fixed income, it is worth checking. The fourth is deferral, different in character from the first 3. It is not a reduction, but a postponement. You put off paying all or part of the tax now, and the unpaid amount accumulates as a lien on your home, often with interest, settled when the home is sold or the owner passes. It can be a lifeline for someone genuinely cash poor and asset rich. The house is the wealth, but the income is too thin to cover the bill. The debt does not disappear. Go into it with eyes open. Now let us look at how 2 specific states handle these tools. Part 2. Texas and Florida as case studies. Texas and Florida are examples. The amounts and rules apply in those states, not necessarily yours. I am using them because the numbers are publicly documented, and I will show you how to find your own state and county in Part 4. For the 2026 tax year, Texas. Texas law shields $140,000 of your home's value from school district taxes for all homesteaders. When you turn 65, you become eligible to stack an additional $60,000 senior exemption on top of that. $200,000 shielded from school district taxes, often one of the biggest drivers of the overall bill. On a $300,000 home with both exemptions, you're only paying school taxes on $100,000 of value. But the most powerful part of the Texas system for a long-term homeowner is the school tax ceiling. The moment you turn 65 and file, Texas freezes your school district tax at whatever amount you paid that first year, not the assessed value, the actual dollar amount you owe. Your school tax bill is frozen at that baseline. It can go lower if rates drop, but not higher under the basic rule. Exceptions can apply for new improvements, certain ownership changes, and local district rules, so confirm the ceiling status directly with your county appraisal district. In a city where values have been climbing steadily for a decade, other homeowners see their bills rise every year. Yours stays at the number from the year you first qualified, a durable benefit that has nothing to do with income. Texas's standard filing deadline for these exemptions is April 30, though the law does allow late applications in some cases, so contact your county appraisal district before assuming you have to wait a full year. Florida. Florida has the Save Our Homes cap, which applies to any homesteaded property. Once homesteaded, the assessed value for tax purposes can rise by no more than 3% a year, or the rate of inflation, whichever is lower. For a senior who has owned a Florida home 20 years, that cap can mean the assessed value is dramatically below market price. On top of that, Florida offers an additional senior exemption up to $50,000 in assessed value, income tested, and local option, meaning counties and municipalities choose whether to adopt it. Where offered, the 2026 household income limit is about $38,600, adjusted yearly for inflation. Those who qualify, typically seniors on Social Security and a modest fixed income, can see savings that make a real difference on a monthly budget. Florida's filing deadline is March 1. Two very different systems, meaningful money at stake, and both require you to act. Which brings us to the one error that costs eligible homeowners an entire year of savings. Part 3. The trap most people fall into. The break does not apply automatically. In most states and counties, you have to file an application at the county assessor's office with proof of your age and that the property is your primary residence. If you move to a new county, you may need to refile. If your spouse has also reached 65, check with your county assessor whether they need to file separately. Rules vary by state and program. The deadline issue is serious. Miss a state's primary filing window, and you may wait 12 months for the next cycle. Some counties allow retroactive or late applications under specific circumstances, but do not assume that without asking. A phone call before the deadline is worth more than an email after it. There is also the income test trap for programs like Florida's additional senior exemption, or most circuit breaker credits. Means tested. So if your household income exceeds the threshold, you will not qualify no matter your age. And there is the stacking question. In some states and counties, you can layer multiple programs together. In others, you get the best one and only one. Ask your assessor explicitly whether you can stack them. The reason so many people leave this money on the table is not that the programs are hidden. They are public record. It is that nobody asked. There is no automatic notice that says, "You turned 65 this year. Here is what you may now qualify for." You have to know to look. Part 4. Exactly what to do right now. Here is your action plan. 4 steps. Step 1. Find your county assessor. not the tax collector, not the state revenue department. In some states, it is called the property appraiser. A quick search for your county name property tax assessor gets you there in under a minute. Step 2. Look for a page called Senior Exemptions or Homestead Exemption or Homestead Tax Relief, a list of programs for homeowners 65 and older. Step 3. Check the 4 categories I walked you through. You do not have to qualify for all 4. Qualifying for one is worth the 20 minutes it takes to file. Step 4. Pay attention to the deadline and the requirements. Proof of age, proof of primary residency, and sometimes a recent tax return if the program is income tested. If you already think you may be getting the senior exemption, pull your most recent property tax statement and find the line that shows exemptions applied. If you are not sure what you are seeing, call the assessor and ask them to walk you through it. That call takes 10 minutes. And if you live in a state with a school tax freeze like Texas, ask specifically whether your freeze was applied and when. Sometimes it was applied late, meaning a prior year may have been overcharged. Part 5. What the dollar actually means. Let me put a real number on this before we close. Depending on your state, county, and home value, a senior exemption plus an assessment freeze can reduce your property tax bill by several hundred to more than $1,000 a year. More in high property tax states. Spread over 10 or 15 years of retirement, that is a number worth a phone call. $1,000 a year will not fix a retirement shortfall on its own, but if you're drawing from your portfolio at a 4% rate, you need $25,000 in additional savings to generate that same $1,000 a year. That takes years to accumulate. The county assessor's form takes an afternoon. The reason so many eligible seniors miss this is simple. Nobody walked them to the door. You now know which door to knock on. Closing. The one thing to take from today, your property tax bill at 65 is not a fixed number. It is a starting point you are allowed to question. In most states, there are programs that can reduce it, freeze it, or defer it. Put there by legislators who voted to protect senior homeowners on fixed incomes. They just did not build in the notification. That part is on you. This is not financial advice, and every situation is different. The amounts, income tests, and deadlines all depend on where you live. Your county assessor is the right person for your specific circumstances. If this gave you something worth checking, hit like before you go. Subscribe if you are not already here, and in the comments, type the word check if you're going to pull your property tax statement this week.